Hi, well, thank you for having me here. I am Ana Cabral Gardner. I'm the co-CEO of Sigma Lithium. Sigma is a Canadian company. We're dedicated to power the next generation of electric vehicles. Those that are going to be built with environmentally sustainable lithium. So what we do high purity, battery grade lithium concentrate. So we are currently in construction. We're fully funded for construction for our lithium project in Brazil. We're building a green tech state-of-the-art plant. It utilizes 100% green energy, clean energy, 100% recycled water, 100% dry stacking. And more importantly, it does not utilize harmful chemicals. So we deployed clean tech, green tech in order to process the lithium from the ore into these highly value-added materials through clean tech technology. So Sigma and this project represents one of the largest and highest grade hard rock lithium projects in all of the Americas, from North America all the way to Patagonia. And since inception, we've been ESG centric because Sigma is controlled by an impact investment fund. So, and that runs the gamut from the ongoing support of local communities to the goal of achieving net zero by 2024.
Ana, thank you very much for joining us. Everything about this project is big. 2.2 billion market cap at the moment. Share price has done extremely well over the last 3 years, ramping up nicely. And you are set to be one of the biggest producers globally. So what I'd like to do, and if it's okay with you, is just going to get a sense of how you built this thing. Because I'm intrigued about how the management teams think about stuff, how they work, and it gives me sort of some sense of what the future could hold. Because the difficult thing is when you get big, you got to kind of keep that growth story component going to this. So maybe let's go back to the beginning. So when did you come across this project, and and how did you get a hold of it?
Absolutely. Well, this is a well-known project, given that it belonged to Sanzagualia in Australia, which is the big bang of lithium. Sanzagualia once owned Greenbushes, Pilbara, Wodgina, and Altura. And this project was co-owned by it and by a family. So the founder in 2012 acquired it from that family that ended up with a project once Sanzagualia went bankrupt. So they had in the area over 200 ore bodies. And the founder and their partner is GP Investments, which is the local arm of the 3Gs. They've worked for 4 years to try to understand these 200 ore bodies. So they narrowed it to 33 ore bodies. 9 out of those were artisanal mines. The family had mining artisanally, right? So fast forward 4 years, when we got involved on year 5 of the company, they had these 33 targets and then what we call the 9 super targets. And what we told them is, look, we are an impact investment fund. You're going to queue the 9 that used to be mines into a path to cash flow. And we're going to blinders down, focus on getting to cash flow as soon as possible. So I think when you asked me how, it was focus, because that's what allowed us to weather the storm. And the storms came. I mean, we lived through a whole bear market cycle of lithium, but because we were focused. So he took the 9 previous artisanal mine and queued them in phases. So we started to work on phase 1. And that is the project that's in construction. But phase 1 is an industrial area, which allows you to put phase 1, phase 2, phase 3. And then the deposits, they're going to feed each one of those line trains of processing. So 9 previous artisanal mines divided in phases. We're now in phase 1. We announced recently phase 2. So phase 1 and 2 combined leads us to an NPV of $5 billion. We're coming on the back of it with phase 3. There might be a phase 4. Actually, there is a phase 4. There is a phase 5. So what we've done that was so successful, we phased it as opposed to doing a mega project because it allowed us to think about the capital structure of each phase separately. It allowed us to basically tackle a large area in bite sizes that were digestible to the capital markets and to the investors, even during the bear cycle.
Right.
So focus and this aim to get into cash flow quickly, that was kind of where the compasses that we followed were.
It's kind of interesting to me, Anna, because that's a very kind of Australian model, and I know you picked this up from an Australian company. Did you pick up some of their strategy or thinking about how they were going to come about it? Because if I look at Canadian companies, they tend to like to drill until they work at the size of this thing. But you're right, cost of capital is important. The scale of the capital is important. So where did you, was this your strategy, or was it, like, say, inherited?
Yeah, because this is the key difference. I mean, we're not a junior mining company. We are a private equity led company. I mean, if you think about my fund, we are still here.
But tell me about, okay, so we'll do that.
Yes.
Who is A10?
Yes.
How was it formed?
Well, just going back to the whole point, right? Why was the strategy different? It weaves back in. We were not planning to sell Dow throughout. So we wanted to stay in until cash flow. So we developed this with a private equity mindset, meaning we're going to go in stages, because as we grow value, we would raise capital in tandem with the growth so that we are not going to be as diluted. So we are still with 97% of our position intact. And we just sold down to Blackrock to allow them in. So Blackrock is our second largest shareholder, our co-investor. But if we're still here, I haven't sold out unless was to bring in more people, right? So ultimately, there's a lot of coherence in what we say and what we do. We wanted to do it in bite sizes so that we wouldn't basically jeopardize our own return on invested capital, because the respect for shareholder money comes from the fact that, well, we're the largest shareholder to begin with. So it was this phased in process, right? And again, answering your question. So who is A10? We were an impact investment fund. And we made that investment 5 years ago on the aftermath of the largest ecological disaster in Brazil, where the project is located. The first tailing dam collapsed and sterilized the whole river. And the mining, metallurgy, anything related to mining became non-investable. These asset classes died for venture capital. And my peers in impact investing decided to run and do impact investing by digital inclusion, fintech. We decided to do the exact opposite because of our backgrounds and the partners' backgrounds. I mean, I was a banker for 25 years, 15 of those spent in natural resources. We decided to dive into the problem, meaning we're going to show that these assets are able to be developed in a completely different way. How? With technology and using state-of-the-art environmental techniques and technologies, which at the time weren't even called ESG. The name of this before was Principles of Responsible Investment, which is kind of puzzling because in our view, every investment should be responsible. But PRI was the north, right? So we followed that to the letter. And every decision we made was very consistent with the principles of responsible investment and with this obsession we had with technology. And that's also a very important aspect of our fund. We all have backgrounds in technology, and we all have backgrounds in economic development. So in addition to being natural resources bankers, we have academic and educational backgrounds and practical working backgrounds in those areas, which means we have one belief, that the resources of the planet are finite, but there's a lot of waste in how these resources are explored. So throwing technology in these areas that are not sexy, like materials, to increase yields is the way to actually better use our resources. And it applies 100% in lithium. If you think about recoveries in lithium, recoveries are very inefficient. A high recovery, which is what we achieve, is like high 60s, right? But you still have a lot of material in the tailings. You look at brines, 40s, right? So with the same resource, you can actually improve yields through technology. And this is not breakthrough, man to the moon kind of technology. These are existing pieces of technology that you combine and enhance in order to drive these yields. Right. And therefore make it environmentally sustainable, more sustainable.
Right. And given the nature of the market that you're playing in, the battery, et cetera, it's solving a specific problem. So I guess you must be seen to be green or clean, however you want to frame it, to be able to kind of attract the likes of Blackrock, which you did in December for quite a chunk of money. So why did you feel it was the right time to bring them on? Was it just to finance the construction component, or what else are they bringing to the table for you guys?
Well, they've been our shareholders since we went public in 2018. Right. So they've been following Sigma for 4 years. Right. When they decided to increase disproportionately their stake in the capital increase and become our second largest shareholder, the main reason was to amplify our voice and amplify our reach in some of these ESG themes. The thematic in our industry has been quite poor in a way. So we became an outlier in the industry and we led the industry. And now I'm actually very, very grateful that the industry sort of followed on the lead, so that, you know, issues such as scope 2, which was power, it's moving to be clean. The industry was not using clean power. He was using dirty power. He was using diesel generators. He was using coal power. He was using natural gas from coal. Gas from coal. So the power matrix of the industry was quite dirty. Then in the operations itself, I mean, our operation was designed, and we have a demonstration plant to scale on site, which was designed, and it was costly. There was 15% more capex at a time when money was expensive, involved in building that plant to be state of the art. 100% dry stacking, 100% water recirculation, did not use hazardous chemicals. So the process is microdensity gravity based. So these three elements plus clean power put us in a whole different category in terms of environmental sustainability. And that was very attractive to institutional investors such as Blackrock, who have exposure to natural resources and who want natural resources to evolve into the 21st century in its mindset. And again, how it will do that, environmental state-of-the-art practices and clean tech, green tech, to increase the yields and to improve the extraction methods, right? It's basically increasing efficiency of what we already have because the resources are finite. Right.
Okay, so you're talking about, you know, high purity, which is good, but you're kind of feeding into an industry where prices are going through the roof. You know, that's of great benefit to you. You're only producing a concentrate, though. Is that kind of like short term goal of yours? Do you want to move further downstream? Will you be producing hydroxides? Was that not part of the model?
Oh no, we love where we are. I mean, we love where we are for a whole host of reasons. We deliver a enhanced concentrate. So the product we deliver is what we call pre-chemical. It's battery grade, high purity concentrate. So the real value creation happens here. We enjoyed margins of 79% operational margins. When you think downstream, chemicals, if you're not integrated, meaning if you're buying your raw materials from folks like us, your margins are 18%. So we're sitting at the holy grail of the entire supply chain, and we studied it, right? Now, why is that? And why do we like it so much? Because going down chemicals involves a whole level of expertise, which frankly today, and the industry has to be humble to say it, is held by China. They do an amazing job in especially in the last two steps of the chemical supply chain, which is ion exchange and crystallization, which is really human skill. So when you think about that, there's more risk and less return. And there's a technology risk there too, because when you build a chemical plant, you choose a cathode technology, which is also in shift, meaning the chemicals, hydroxide, they feed high nickel batteries. The chemical carbonate feeds LFP batteries, which is no nickel. And that's also in flux. As you know, we've been following the main car makers trying to shift away from high nickel back to a non-nickel. And when you make that decision at a chemical level, you're marrying yourself to a technological area where there's quite a lot of change and it's very dynamic. So here we are sitting in pre-chemicals. We call what we do pre-chemicals because it's high purity, it's battery grade. So it's teeing up the chemical, and we don't have any technology risk in the sense that we're not marrying to any decisions that are out of our control downstream. What's most interesting about where we are, and we like it so much, is that because we do it so well, I mean, we enjoy this pre-chemical status because our material drives cash flow, meaning a client like downstream, you need 20 to 30% less of this material because of its purity and its coarseness, hence the pre-chemical status to deliver the same tonnage of the chemical. So we are enablers to more efficiencies. So this is why we sit at such a great vantage point chemically and therefore commercially.
I love the fact that you are delighted to defend that position, because a lot of the conversations we have with lithium companies is them saying, we're going to produce a concentrate, but we will definitely be moving downstream, because they're hoping for a re-rate if they do. What they are not owning is the fact that if you can get it right in the concentrate space, there's every reason to be very happy to stay there. So that I thought it was quite interesting, because we had the ex-chairman of, I think, Albemarle come on a couple of months ago and talk about a lot of the lithium developers talking a technology game which they're not equipped to deliver, whether that be DLE or otherwise, because it's a very technical product that you're producing. So I like that. But the only reason I mention that is because here's the actual question I called you up to talk about, right? Which is your valuation. Okay, most people look at it and go, 2.2 billion. You guys have done quite well in 5 years. Well done. But it seems to me, looking at some basic peer analysis, you can measure it on any value you want. You're not getting the love and attention that I think perhaps you might be due. And I'm trying to wonder why, right? And normally that's going to be jurisdictional risk, technology risk, offtake or contracts, or your ability to create margin, because some of these projects are very marginal. You were talking a game of high margin, the exchange that you sit on, lots of reasons why people may be discounting you. I mean, how do you feel about it? I mean, how do you think people should be looking at you?
Well, we had a liquidity discount that was quite punitive because there was no stock, right, for a long time, up until we listed in the NASDAQ in September. So we are, from a investor's perspective, a newly available stock. Up until we went to the NASDAQ, the stock traded like $200,000 a day. That's basically nothing, right? So going to the NASDAQ, you can see, I mean, we started to be rewarded for our execution. We were flat. We went to the NASDAQ almost at IPO prices, right? So as we went to the NASDAQ and you started to see a turn in the shareholder base from the very early guys in Canada from 2017 and 18 into the folks that will look at the re-rating, and I'll talk about it now, that's when we started to see the execution being factored into the share price. And there's a long way to go. And why is that? Because, and these are numbers that I can talk about because they're official 43-101 numbers. Our 43-101 EBITDA combined, and that's done at a $2,000 a ton, which is half of the current market, it's $730 million of EBITDA. If our market cap is like 2 billion, it means we're trading at like 3 times EBITDA. So that's, no matter what sector you look at, a company at 3 times EBITDA is attractively valued. So when you look at the metrics that us private equity investors like to look at, which is kind of my goal, is like cash flow. Cash flow will re-rate the company. We are confident that the moment we do first shipment will be at current market prices, which are more like 5,000, right? There will be a double re-rating, because when you think about what we're doing, well, we are in a great jurisdiction. I mean, there are companies in Africa that have higher valuations than us. Brazil is probably one of the most solid jurisdictions in mining in the world. Half of the world's metals come from Brazil. The other half comes from Australia and Canada. So it's there. It's investable. It's been investable for, decades. Then you have, so it's not jurisdictional risk. When we look at execution risk, we're fully funded, solid investor base. Blackrock, second largest investor. The investor list reads like a who's who in investor registered. So fully funded to construction. So construction risk is extremely well managed, because we spent a whole year in detail engineering, which again, typically junior companies don't do. We did that because we are, again, private equity investors. We were in a hurry, but we were not willing to sacrifice risk for rush, right? So we were not in a rush. We were in a hurry, which are different things. So we spent time de-risking construction. So in our view, the one explanation for the asymmetry, and there was a major price asymmetry during valuation asymmetry, was liquidity, which is the gap we're closing, doing this outreach of awareness, talking to folks like you guys, being more present in conferences, because we had our blinders down. We were so focused, how racing horses do? We're like blinders down, executing. So we feel that, construction's on rails. We delivered phase 2. We're publishing phase 3 shortly. So my co-CEO lives at the project. So he's there, running that construction. But then it allowed me time, it released me some time to go out and do this investor awareness work.
So talk to me, give me a little bit more technically with regards to the product, the concentrate. So clearly funded through to final construction, and which is great. Who are you selling this to? BlackRock being part of this leads me to believe that it's got to be North America, surely. Yet China's the big 800-pound gorilla in the room here. So how do your future finances look, and where's that money come from?
Well, we're being funded by the equity capital market. So so we don't have clients as funders. That's an important point. Mm-hmm. So the shareholder register is clean. It only has financial investors. That's one. Now, the commercial strategy, we're completely agnostic. We sell to everyone. I mean, this is the advantage of having an asset in Brazil. It's a neutral place. We sell to everyone. What we've done, though, we aligned ourselves with the biggest players. So the one public client we like to talk about is LG. LG is what we call the unanimity in the sector, because they deliver their batteries to Ferrari, to Volkswagen, and then to Tesla, to GM. They deliver to Tesla in China. They have 3 planned facilities in China. They have 2 joint ventures planned in North America, very famously, one with Stellantis and another with GM. So there's an alignment with us. We're here to make the world greener and more sustainable, and we will go wherever it takes. We will associate ourselves with the best in class to do it, right? Across the spectrum. The market's now half China, half Europe. The US is developing as a third force. We see eventually the market becoming tripartite, US, Europe, and China. So we're sitting here with this asset in Brazil, completely neutral. And we love that fact, because we see competencies emerging from the various jurisdictions, right? You have the chemical prowess coming from China. You have, the growth and the awareness of the consumer for sustainability issues coming from Europe. Europe's driving all of this. Europe's driving the sustainability in the supply chain. So each of these markets brings something to the table, I guess.
So you're agnostic in terms of who you sell this to.
Totally.
But here's the bit, because I want to learn, right? I want to learn as an investor, what to look for next time round, right? Which is, how have you managed to get this to a point where you're fully funded through construction without putting offtake agreements in place, or selling down to a strategic player, a chunk of your company? Because a lot of the companies which are trying to move through from pilot plant to demonstration plant to commercial plant, they've needed the help of industry to kind of move forward technically, but also financially. So how have you avoided that, or have you avoided that?
Well, we have offtake agreements. We had to put the agreements in place.
To what percentage of your product?
If you were to add it up to half of the phases to be committed. And we have optional volumes at our option. So we have that flexibility to play with. So this was the art. Now, what allowed us to do that was the capital. We are well funded to begin with because of the fund. So, and this was more evident in 2019 when capital was nil. So we actually wrote a check for the company, and we didn't do it as a capital increase. We lent it below market rates, which earned us the huge respect of our shareholders, because it showed that we were willing to put more money where our beliefs were. So that precluded us from getting funding from strategics, precluded us from getting funded from offtake players. But we have the offtake. So we have this offtake with LG.
But what percentage does that represent, though? They're not 50%, are they?
It was half of phase one, right? It was 100,000 tons. And then it has another 50,000 tons of optional volume. So then we also had Mitsui as a trading partner. They were a commercial partner, and they move materials, with a very big ease. So we've aligned ourselves with the best, basically. So by aligning ourselves with the best, we knew that, we would have the battery make, and this was a key thing, because of the quality of the material, and because we bring in this 20 to 30% productivity boost that is not priced in a quote. We actually went over and jumped 2 boxes in the supply chain. We jumped chemicals and we jumped cathodes straight into battery makers, straight into end users. And the end users buy the material, and they procure the chemical conversion and the cathode making. In the case of LG, it's the same house. And therefore, what is interesting is that as a result, we gained more commercial power. We were able to share the gains, because the further downstream you are, the more focused they are with the unit securement versus nickel and diming, the product, right?
Right. Okay. So this is what you talked in the past about the take-or-pay contract price being linked to the lithium hydroxide price, right? And I think that's from October last year or whatever. So is that normal in this environment? Because when we talk to battery manufacturers in the past, they're like, we just need to secure our supply. The market's moving quicker than we thought. The numbers are bigger than we thought. And, the important thing is just securing supply of the right quality product. So to say, they don't want to nickel and dime you. So you were able to take advantage of that situation, I guess. That's what we're saying. That's
exactly, because when you look at the battery makers, they're building these gigafactories. And when they look upstream from where they are, they don't see the volumes coming from upstream. So there's been now a focus on how can we get the best product into our fold, so that we can actually ensure that we're going to get the chemicals to the right certification, that we're going to get, and they can't take any risk there. This is my point about us staying away from chemicals. They procure with their tollers, but with our material, which is an enabler, which is a whole subtlety, because the fact we deliver this material so pure and so porous allows the battery makers more choices on tolling, because they're able to deliver this to tollers that can deliver certifications, they can deliver in specification material, but they didn't have access to great input, to the great pre-chemical in order to do so. So given great material, they can deliver the certified chemicals. And that's what we do. That's the alliance with the battery makers. It works beautifully. And so we actually enable the battery makers to have more choice to their advantage and more certainty in executing their investment plans, which are, as you know, quite substantial.
Well, absolutely. And one of the other things that came out of these conversations with the battery manufacturers is saying that we're not actually quite sure or confident enough to actually understand. A lot of the development stories are talking a good game about what they're going to be able to do. And maybe this, reflects on the conversation from the ex-chairman of Albemarle as well, which is some of these daily stories, some of these development stories are not actually going to get, they're not getting to the point where they can produce the product they say they can in the time frame that they say they can, if indeed they do. So not all developers will get into production, I guess is what I'm saying. So with that in mind, what do you think is going to happen with pricing? And that's a difficult game to get into, trying to forecast pricing.
I'm happy to answer that. I think the workhorses of the industry are the majors. And Sigma, fortunately, is in a position, and that's how we call it, we're the next major. And the majors are a very sort of select group of very large producers that can scale up, right? So the majors are known, meaning you got Albemarle, you have SQM, there's Pilbara, major players, right? And then you have, the non-integrated. So you got Ganfeng coming in there, part integrated with mineral resources. And then you have Sigma, like delivering, not a chemical producer, delivering battery grade, just like Pilbara, delivering battery grade pre-chemical, right? Ultra high purity. And then you have the balance of it, right? So all the other players, but these majors, super majors, we are the workhorses of the industry. So then you have the new players emerging. And then the question is, in this cycle, that's it, is basically Sigma, Lithium Americas, and Core in different scales, in different speeds. So the question with the developers is, okay, you're going for the next cycle. You're going to produce in 25, 26, 27. Will you get funded? Are your capital plans executable with the current market sentiment? Can you get that? Is it realistic? Is it focused? So I look at these things. I'm an investor. I'm actually a professional private equity investor. So when I look at this, I have an investor's eye of how realistic, time to market, time to cash flow. That's what we care about. Wow. When are you going to start turning out cash flow? And is your CapEx to get there realistic? And is your product realistic to the skill set of the management? So these are the discussions that we think through internally when we look at an investable opportunity. So when you talk to a group of investors, it's always the same question, right? Does this team have the skill? Is there a strategy to, especially in the current environment where capital is going to become scarce again or more expensive again, is this focus? Like because like we developed this in a bear market, straight line to cash flow. That's blinders down, cash flow, obsession, that one asset. These are the questions. I can't answer them. Each company has its own micro, realities, but the bigger questions are those for investors. That's our investment process is.
Literally, the definition of time is money. And I really like that. And I guess what the other kind of bit I hark back to from my banking days is when we're looking at funding projects like this, and even now with running the family office, is we want to understand what the market's going to do. Because right now, people would argue the beginning of this kind of super cycle, the EV revolution has kind of changed the focus and narrative for sure. But I want to know that the pricing is sustainable. And if I am going to invest in any of these other developers, I've got to believe that they've got a chance of surviving. However, if the majors, which you are soon to be one, are able to turn the tap on and increase supply into the market, that does start to affect that critical tension between pricing and supply in the market. So, are you concerned at all about the kind of fluid position of lithium at the moment, the various lithium products in the market?
Well, it all depends. It's not a one size fits all because there's a cost curve, and that happens in every commodity, right? As you know. So you always want to bid from the middle to the low end of the cost curve. If you're sitting from the middle to the high end of the cost curve, you have a more fragile position. So when you think about where Sigma is, I mean, we are at the lowest quartile of the cost curve. This is one of the lowest cost projects in the world for either chemical. No matter what they do with the battery grade concentrate, carbonate or hydroxide, we can, be right there after the gods, which are the Atacama and Greenbushes, right? Why? Because we were developed during the bear cycle when the product price was $500 per ton. It's now $5,000. So we had to show we stood on our own two legs at $500 a ton, and we did. So that is the key. Now, how many projects like these are there? Well, not many. So you move up the cost curve. And that was my belief when we stayed on course in 19, when we put our own money here. If this is it, well, there's no EVs because there's not going to be enough products. There aren't enough assets that can stand on their two legs at these price levels. So the billion-dollar question is, what is the long-term price levels? And then the experts have their views, right? And that long-term price level needs to converse with two things: with the availability of assets and production increases from majors that fall from the middle to the low end of the cost curve, one, and with the growth plans of the downstream industry, meaning are they putting out gigafactories and announcements that can be supplied with this amounts of materials coming from the middle of the cost curve to the low end of the cost curve? Or do we have to push sort of the cost curve a bit further towards the high end of the cost curve? So this is the question for, let's say, 24, 25, 26, when everyone is concerned that the prices will taper. Right now, it's all the way to the end of the cost curve. Every single project with a gram of lithium out there is being thrown into the market at these levels. It's $80,000 a ton of hydroxide, $6,000 a ton of lithium concentrate and counting. But this isn't going to last. And the question is how long? It's not going to last. This can't be reality. But what's the reality? Well, depends. Depends on demand uptake, the battery gigafactory, investment rollout plan, investor uptake of the electric cars, and is there a coherence that percolates throughout the supply chain between these two, these two elements, right?
So I agree with all of that. I think we've got to be, we as investors have got to be realistic, and the market has a way of finding its level, right? So I'm sort of intrigued as to what you thought about what would be driving that pricing and what are the levers involved. So I've enjoyed that. Just with regards to your driver, which is time to cash flow, right? Time to cash flow. So give us a sense of that, because I'm used up a lot of your time today, and I think there's so many other things I want to talk about, like COP26 and ESG more broadly, and some of this clean techs that you've employed, but maybe for another time. But time to cash flow, what are you aiming for in terms of phase one, and what's the kind of ramp up to phase two look like?
Oh no, we're there, right? Basically, we're in construction.
But
we're
money.
Commissioning.
Show me the money, Anna.
Yes, we're there. We're obsessed. Basically, we're fully funded. We're equity funded, which has enormous advantages, mainly with the current state of supply chain disarray. I mean, we behave like a major. In other words, we prepay our suppliers. We put money to ensure timeliness of deliveries. So even in an appended supply chain, I mean, you got Shanghai in lockdown, there are parts of every manufactured good, even though you're not buying from China or you're buying parts from China, China is it's integrated to supply chains in the most surprising ways, and everyone's finding out now. So we're trying to do our best in buying our way into supply timeliness by using that cash funding. This is significant in this market. So far, so good. We've been able to maintain our commissioning timeline of December year end, which switches on. Then the first quarter is when we commission. So we'll have lithium on the ground throughout first quarter and we'll ship. So ultimately, I mean, we're there. It's first quarter 23 product ramp. Again, simplicity of the technology, simple. So the DMS is a quick ramp because I'm ramping 6 processes, not 14 processes. So quick ramp, quick to market, 3 months ramp up, perhaps shorter. Phase 2 starts getting built the moment I switch on phase 1. So phase 1 starts first quarter 23, the production. Phase 2 starts the construction there. So then phase 2 goes on stream in 24. So phase 1 and phase 2, quick succession, broken down into 2. 23, phase 1, 24, phase 2. And we're working very fast on a phase 3, which we already announced and discussed. So the objective now is to be able to deliver as much as we can of this sustainable lithium throughout these next 3 years.